You've been watching the economic data come in lately. You might be feeling a little whiplash. Friday, we saw a big plunge in consumer sentiment. Today, a huge jump in retail sales. January sales surged 13% year over year. Industrial production also coming in pretty strong. None of that points towards a looming slowdown. Maybe my next guest can help separate the signal from the noise here. He was the first to call for 7 rate hikes this year. And joining me now is Ethan Harris. He's the head of global economics at BofA Securities. Ethan, welcome back. It's great to have you.
Thank you.
Can I just start with, when you see people worried about recession because consumer sentiment is tanking and the yield curve is, all the things that normally point in that direction, do you think the odds of a slowdown are higher, or are they not? Tell me what you think is going on in the landscape here.
So I think the sentiment indicators are suggesting that people are just in bad mood. I mean, people are tired of COVID and being locked up and wearing masks. People are concerned about very high inflation, and they're just in a bad mood, and they're expressing it in the surveys. I don't think this means they're going to stop shopping, as we could see with the retail sales report today. You could even argue that shopping becomes kind of retail therapy if you're kind of depressed about COVID. So I don't take much of a signal from the conference numbers. I think the economy's got solid momentum.
What about the yield curve, which isn't a traditional economic indicator, but is obviously one that, people follow?
Yeah, I mean, the yield curve is going to be flattening over time as the Fed hikes rates. And so I don't think we should be alarmed by that. I think that's a normal part of the process of getting back to normal in terms of monetary policy. At some point, the curve may invert, which historically did signal recessions. But we need to be cautious about that because these days, the long end of the U.S. market, the 10-year yield, is very distorted to the downside by foreign demand. And so it's not hard to invert the curve. You just have a regular rate hikes from the Fed, the long end being held down by foreign investors. And so it's not a reliable signal anymore. It's a signal that foreigners love to buy U.S. bonds because their interest rates are so low. So I don't worry too much about the flattening of the curve. Eventually it may be a problem, but not now.